I'm Sarah Williamson, and this is Going Long with FCLT Global. On this show, you'll learn what it means to be long-term from the top minds in global business and investing. Leaders from companies and investment organizations join us to discuss how they are leading their teams for the long run on issues including capital allocation, risk management, climate change, and sustainability. To learn more, visit our website at fcltglobal.org. Today, our guest is Seth Alexander, who is the president of the MIT Investment Management Company, or MITIMCo. MITIMCo manages the endowment retirement plan, retiree welfare benefit plan, and other financial assets of MIT. Prior to joining MIT, Seth was a director at the Yale Investment Office. Seth's also a member of the Whitehead Institute Investment Advisory Committee, an investment committee member of the Board of Managers, and investment committee member of CRICO. So Seth, thank you for joining us today to talk about long-term investing.
Sarah, thank you for having me.
Your mission at MITIMCo is to deliver outstanding long-term investment returns for MIT. So that is a big goal, particularly as you consider you're funding not only the endowment of a top educational institution, but you're also trying to fund, cutting edge research, innovation. The cost of those things keep going up a lot. How do you, with all that in mind, how do you measure success? What do the goals look like? How do you really think about what you're trying to get done?
Sure. So we really think about success as the success of our stakeholders, and our primary stakeholders, and I'll talk about our secondary stakeholders in a minute, but our primary stakeholders are the MIT community. And so we try to think about what are the things that they need to pursue their research goals, to pursue their educational goals. And quite simply, it's a growing set of resources over time. And so, are we able to deliver growing endowment spending, over 5, 10, 20, 30-year periods, such that the research they can do, now can be even greater in the future, and the new challenges they can take on will continue to be, kind of worthy of MIT's effort. I think that also mixes very well with another set of stakeholders, which is our donors. Our donors have given money to MIT, and to the extent they make endowed gifts, they give them with the expectation that these gifts are going to support this research for decades at a time. And so if we're able to maintain the purchasing power of their gifts over time, and that donor's gift 50 years ago is still giving to MIT in the same impact as it was 50 years before. And so if we have this idea, and we do, that MIT, the work that MIT does will be just as important 50 years from now as it is today, we need to keep this endowment growing. So that's, I think those are our primary stakeholders. We also have stakeholders in the sense that we partner with external investment managers. And the success of this ecosystem depends on us being able to partner with exceptional external managers. So they need to be happy. If we can play some role in helping them be successful on a long-term basis, and it's a great partnership, that is also kind of a way of defining success. And then the only other thing I would mention on success, and the kind of key to defining, how we measure success in very specific, maybe, I've talked very qualitatively in more numerical terms, is we do want to think on a long-term time horizon. And so, we reinvest, maybe between 5 and 10% of the endowment every year, just as kind of normal capital flows, move around. And therefore, we're making investments that kind of have a 5 to 10 year duration to them. And therefore, when we look at our numbers, we want to measure our performance, kind of based on that time horizon. We're a little bit of the super tanker that's, hard to maneuver very nimbly. And so we're not kind of focused on how do we do last month or last quarter or even last year. And so as we think about these success metrics, it really is over those time horizons. And so over 5 and 10 year periods, can we grow the resources to MIT? Can we be a good partner to investment managers? Can we maintain the purchasing power of our donor gifts? And then there's probably, there is some competitive element to this, in the sense that MIT competes with other research institutions around the world, for students and faculty. And if we're not keeping up with those institutions will be able to, offer better packages and recruit away our faculty and our students. And so therefore, we do have to be able to keep up with other people as well. And I also kind of like that that test because there's lots of other smart people investing other institutional capital out there. And so we can kind of compare ourselves to how they're doing at the same time. We're thinking about just driving absolute returns as well. So maybe that was a long-winded explanation of how we think about success, but that really is a multifaceted approach.
So it is a multifaceted approach. And as you said, there's a number of things you're comparing against and over different time periods. But what you didn't say was how we did, last quarter, last year against some policy portfolio benchmark, or even, XYZ university across the street down the, in another part of the country, whatever it is. So as you think about those various measures, how do you get your stakeholders and your constituents to focus on the longer term ones? Because when you do very well, it's really easy to say, oh, well, we just made a lot of money, let's spend it all, or now I'm going to assume that's going to happen again next year. So how do you teach that long-term 5 or 10 year in a world where people like to say, oh, well, so-and-so beat so-and-so last year in the, 1 year return?
Yeah, we try, certainly internally, we work really hard to be transparent in the process by which we make investment decisions. And so, here's how we think about, hiring this manager. Here's how we think about this capital allocation decision. Here's how we're thinking about, how we build our team. Here's the types of people we're hiring. And so there are these interim information points that we certainly are sharing with the MIT administration, with the board, kind of the general governance around MIT, to show them, like, here are all the things that are going into, our thoughts and our judgments and our decisions. And that gives them the ability to make some judgment around, is this a process by which they think, we will generate the long-term returns? And so we give ourselves a little runway to let those numbers play out. But honestly, it is difficult because every year, the news media event, inevitably will pick up, hey, this university did this, as you said, this university did this university did that, and everybody likes to make those comparisons, and we're all competitive people. And so, we'd love to win over every time horizon. And we just have to kind of keep taking ourselves back to the stakeholders, and what the stakeholders really want is not like a 1 year victory. What they want is, the 5, the 10, the 15 years of really growing resources and really kind of, being able to provide the differentiated economics to the university so that we can do new things. And so we can not only continue the things we're doing, but expand into other areas. And so if we can do that, like, that's our real definition of success, not these kind of one-term, one time, hey, I did really well this year, how did you do, type of comparisons. But it's hard to get out of that game.
Yeah, no, that's a game, unfortunately, a lot of investors find themselves in that is often not particularly productive. So learning how to get out of it is important.
I shouldn't complain though, because like we announce our results once a year, right? Which is most investors, a lot of investors have to announce their results every day, in the mutual fund world, or every quarter. We are fortunate in that we at least have that time horizon of a year, but even that is too short really to measure results appropriately.
Right. And as you said, it's not like you could move the portfolio on a dime if you wanted to. Many of these things are locked up for long periods of time. It's a super tanker. So
that's exactly right.
So as you think about the portfolio overall, I know it's very diversified. You try to make it resilient. If obviously markets are volatile and always will be. But I know you work with, whether it's real estate, venture capital, private equity, public equity, various sorts of managers. Can you talk a little bit about how you think about who you want to partner with? What are the kind of skills you're looking for? How do you mentioned them, your managers, as one of your important stakeholders? What is it that you're looking for that maybe is a little bit less typical than other people? And is that long-term time frame, how does that play into that?
Sure. I think one of the things we do a little bit differently than a lot of other institutional investors is we do not start out with a top-down asset allocation framework. And so everything really is driven from the bottom up. We have some top-down risk controls to ensure the portfolio remains diversified. But really our decisions on where to allocate capital are very much driven by individual managers and by which managers we can find and partner with. So the question you're asking is the key component to our investment strategy. And our whole thesis is that if we can find the Warren Buffett of a given area, it doesn't really matter what asset class it is. That type of talent applied to an interesting investment niche will generate the type of results that we're looking for on a long-term basis. And so then it becomes a question for us of, okay, well, how do we go about identifying that? And so what do we look for in partners? And it really is two things. One is competitive advantage. And so why is this particular investment manager better suited to access, value, and own this particular set of assets than all the other investment managers that are looking at the same set of assets? And there are lots of different answers to that question depending on which sector of the investment world you're looking at. And so the competitive advantage for a venture capitalist is going to be very different than the competitive advantage for a real estate manager or a stock picker. But our job is to go out and say in each of those areas is to say, okay, what's the competitive advantage? How sustainable is it? And is this manager likely to continue to grow that competitive advantage over time in ways that will allow them to generate compelling returns? And so we're constantly asking ourselves those questions, and that's the fun part of the business, is trying to apply that logic to a lot of different areas. So that's about half the equation. The other half of the equation is, will these managers who have these great competitive advantages, will they be good fiduciaries and good partners, to us? So at the first sign of success, do the managers go out and double their fees, or go into another line of business, or grow assets, or or just do something that treats limited partners badly? To say, of course, there's a whole set of people who might do unethical things, or fraud, or all the kind of things we want to stay away from. We kind of put under this category of like good fiduciaries, good partners. In that, we're really trying to drill into understanding people's motivations. Why are they managing money? Are they managing money to get as rich as possible? Do they care about the fact that if they make money for us, that helps MIT and that helps our research? So we're looking into lots of different ways of trying to understand how people will behave over time. It's obviously not a perfect science, but understanding people's past histories, understanding their motivations, understanding how they make decisions. We kind of go through all those different exercises to try and identify good partnership, and where those things line up, that kind of great competitive advantage and great fiduciaries. That's when we want to partner with somebody and invest with them, and hopefully invest with them for multi-decades, because it's rare, and we can find these combinations that really make sense and work together. So when we find them, we want to partner with them, and we want to put significant amounts of capital to work if we can.
So it sounds like partly an investment analysis, and partly almost psychoanalysis, personality analysis, whatever, really trying to get under their skin. I know sometimes you back managers pretty early in their life cycle. As you said, you want to be able to, you're trying to find the Warren Buffett of the next generation, not the last generation. So how do you, and I'm sure sometimes you get that right and sometimes you get that wrong. How do you both guess whether they'll continue this? Because if they're young and they're hungry, they may make promises that are a little bit different than when they're old and successful. And then what do you look for to show that somebody's mindset is shifting from that long-term fiduciary mindset to maybe more short-sighted?
We have this constant struggle between evidence and duration. And so the more evidence you have of an investment manager's exceptionality, almost by definition, the shorter the future runway you have, right? So if they have a great 10-year track record, that's 10 years less runway than had you backed them, early on. But of course, very early on, is there any actual evidence to suggest that they'll be great investors? And so we're looking for that point along that line where is there sufficient evidence for us to be able to, make a bet and lean into it. And the thing we've come to is that we've erred on the side of less evidence and more duration. And that is because the power of duration and long relationship for us is so powerful. If we can invest, some piece of our endowment and invest it with a manager and have that manager relationship last for a couple of decades, that is a piece of the portfolio we do not have to reinvest every year or even every 5 years. And so we can kind of turn our attention to the rest of the portfolio. And so the more of the portfolio that we can get into these long duration relationships that are working really well, the more our attention can focus on the rest of the portfolio, and the higher quality decisions we can make because our attention is more focused, and actually the amount of capital we have to invest is more limited. And in a world that's often frenetic, the value of being able to focus and only have to move a little bit of our capital every year is extraordinary. So that's our bias. Our bias has been to go early, and then we've tried to develop the tools and the internal expertise to understand, how do you identify an early manager, because it is different than identifying a manager later on. It is much more about the inputs to the process, about the personality traits, the characteristics, the history of their past decision making, which maybe when they worked at another firm, or maybe when they were, just decisions in their life. So we're spending a lot more time analyzing those things as opposed to, take us through the last 10 years of stock trades that you did, because we don't have that information. So it is a different analysis, and we really worked hard to trying to develop skills in that early analysis. And we have any early manager who's listening to this, we've done this a bunch of times, and we'd love for people to reach out to us at any stage of development. But then you also asked about, how do we tell when managers start to transition, maybe away from being kind of early and really motivated, and, maybe they drift off, and that happens to people over time. There are people who, get bored, with the business, or realize they really weren't it because they wanted to make a lot of money, as opposed to, they loved doing it, or, their ambitions are not about having an exceptional track record. Their ambitions are about, building a huge asset management business, or whatever it is. Lots of things can happen. And by the way, those, some of those life choices, somebody wants to go out and build a big business, that may be great. And we may wish them well in that endeavor. We just may not want to participate on that journey. And so we try to monitor things over time, and, have good relationships with people, and we talk about these things over time, and then we look to see what their actions are. And at some point it becomes very clear if the focus is on exceptionality in investment returns, or, big monetary outcomes for themselves, or a big, asset management business. You can see those decision points along the way. And obviously there are gray areas in there. It's not like every decision is, takes you in one direction or the other. But eventually over time, you kind of do see where things are headed. And often we'll use that as a point to exit. And often we often maintain very good relationships with people because we tend to exit slowly over time. We tend to exit at times when other people are coming in. And so we don't, we're not hurting anybody's business in a significant way by moving on. So there's kind of just a nice life cycle to some of these things, which tends to work out pretty well in most cases.
And then obviously you have a lot of money to manage, but some people have a lot more. And so, the right manager for you may not be the right manager for somebody who has, $300 billion to manage, or something like that. So no, that makes sense. So one of the things you mentioned is you don't have the top down, we're going to put X percent in public equity and X for private and X in fixed income. I understand your team is also not structured like that, which it is commonly in other places. You've got the private equity people, the public equity people, the fixed income people, whatever it is. So how do you build that team that can really compare across asset classes? Because what you're trying to do, you're comparing apples and oranges a lot. Do you put your money with, this interesting manager in this space, or this other interesting manager in a totally different asset class or a totally different country? they're not apples to apples. So how do you make those comparisons, and how do you build a team that can make those comparisons?
We do have a fairly different team structure. So both in the fact that everybody in investment staff is a generalist, as well as the fact that we have no hierarchy. And so, people don't have titles. And the analogy, it's not a perfect analogy, but the analogy I would use is we're more akin to a venture capital partnership, than a typical, institutional investment, house where you have, different tiers and silos and, different people with, very specific targets. And our thesis has always been that if we're gonna adopt this model of making bottom-up manager decisions and really allowing that to drive capital allocation decisions as opposed to the top-down framework, then we really need a team structure to match that. And that, without opining on if one team structure is better than another, it does seem important that your team structure is aligned with your strategy and vice versa. And so that's what we're really trying to do is to say, we're not going to limit ourselves to, hey, let's put, 10% of our portfolio, targeted into US equities and then build it from there. If you did that, you might want somebody dedicated after that. But if you say, look, we want people who are thinking very broadly across asset classes, who are thinking very broadly across geographies, then maybe you want a team structure that allows for that, flexibility, because the portfolio allows for that flexibility. And we want people to make the best possible capital allocation decisions as opposed to be, having decisions limited by, some artificial internal organizational constraint. I mean, the other thing, which I was listening to an audiobook this morning, and they made this kind of point, which was, and it was actually a book about a venture capital partnership, and the venture capital partnership said, hey, if you treat people like analysts, they're going to act like analysts. And an analyst is somebody who is really good at identifying like the pros and cons of everything. They can lay out all the facts. But we're trying to build people internally here who are both good at doing that and then making a decision. So as opposed to an organization where there's a bunch of analysts who kind of bring the decision up to me, and then I make the decision, which we think is very suboptimal. We really want that decision-making authority to be, spread out across the organization. And so we're looking to build a team, to circle back and actually answer your question, to build a team, we're looking for people who will thrive in that type of environment, where it's a little less structured. So it's, there's a little less, kind of like one-to-one mentorship. Because we all work with each other, and there's a little bit less, hey, you're in charge of, hedge funds in Europe type of, clear lines of responsibility, and much more of, hey, let's work together and figure this out. Let's go find some interesting things to do together. We do work in teams, and so it's not, ad hoc teams kind of form around everything we do. And so it's not as if we're, kind of throwing individuals off by themselves, or we're going in lots of different directions. So we retain a very collegial team element. We have a very small team, so the structure also doesn't work if we got too big. So we're about a dozen investment professionals right now. So we can all sit around the same table. We can all have good communication. And work together, very easily. And so finding the people who thrive in that environment would have the, the qualities you would think, people who, are a little bit entrepreneurial, who like to take initiative, who can, thrive in unstructured environments, who love to learn. We have the great advantage of, our manager base is, some of the world's experts in all kinds of different areas. And so if we want to learn something, they're a great resource for us. And so there's some really nice feedback loops around that. And then we just really we want people who, end up with a really good investment sense, who become really good investors over time, who really are able to identify this kind of, oh, here's an unusual situation, an unusual manager, an unusually cheap asset, and an unusual opportunity set because of something going on in the world, and kind of say, hey, this is something we should do. And so that's maybe that's a little bit of stream of consciousness on how we try to build the team.
No, that makes sense, but it is very different than, a big investment organization that has hundreds of people and they need somebody to be, use your example, the expert on hedge funds in Europe, to fill a box. And so there's also that long-term time frame, because some organizations essentially reward people on getting money to work or getting a deal done. Because they have so much money to put to work, or they need to move the portfolio, they're trying to move a super tanker quickly or something. So whereas it seems like your team, if they're going to put money to work, it's going to take a while to know whether they made the right decision or not, right? I mean, it takes a while for it to come to fruition. So maybe there's also a little bit of that, like a gardener watching what you grow come up, or something that you'd also have to have too. So,
absolutely. And I should mention my teammates would be mad at me if I didn't mention that we actually are hiring. So if anybody listens to this and it sounds intriguing, visit our website. This is MITIMCo.org, because we are looking to, bring one or two, new people in.
No, that's great. Well, I know it's a great place to have challenging investment conversations. So that would be great. So mostly we've talked about, managers, bottom up, how you structure things, but clearly there are big things going on in the world, macroeconomic trends that we are seeing. So, how do you incorporate those top down things? So things that are top of mind these days, for example, inflation, geopolitics, there are things that buffet everybody in different ways. How do you build that in? And how do you try to figure out if something is more temporary, where you just kind of have to ride through it? This is always the problem as an investor. Is it temporary? It's just a short-term blip, or has something really changed? How do you think about incorporating those big trends?
Our primary thesis is that we will not be good at identifying the difference between something that's temporary and something that's permanent in most cases. So that our base rate assumption should be, we don't know. And therefore our response to most events is to trust our manager partners to handle it. And so on a bottom-up basis, of course, they're looking at individual companies, individual assets, and they will react to world events, and oil prices changes, whatever the event is, inflation, salaries are going up, or wages are going up at different companies. They will build in those assumptions into their models, and they will react to those events. And that is kind of our primary assumption, is that most things will be taken care of that way. Now there are some other things where maybe we can do something on top of that. But even I would say, just before I give an example of that, even clear paradigm shifts, can be hard to know exactly how to position the portfolio for even a clear paradigm shift. And so if you said, hey, the renewable energy is a clear paradigm shift, that the world is moving towards renewable energy, the question of, how and when that happens is a bit uncertain. And so if you're thinking about how do I position my portfolio from a top-down basis, it can be very difficult to make that judgment. It's easier, again, if you're looking at individual assets. But let me give you an example of where we have reacted to what we would view as a paradigm shift, which was maybe 8 or 9 or 10 years ago. We went systematically through our portfolio and asked our investment managers about how the internet was impacting their strategy, and it, so how is the disruptive potential of the internet affecting what is going on with the particular assets that they own. And in most cases, the managers answered very thoughtfully and said, here's what's going on. Here's the new disruptive technology. Here's why I've invested in it, or here is how the incumbent is going to be able to use that technology better than the newcomer, or here's why that this really isn't an issue for me. In a few cases, we had investment managers who said, I work in, this industry, the internet's, that's a tech issue. That's not an issue here. And that was a big signal to us that we needed to kind of go systematically through the portfolio and get ourselves out of investment managers who were not, didn't mean everybody had to be an internet investor or invest in companies benefiting by the internet, but we wanted everybody in the portfolio to at least be, thinking about that potential risk and to kind of check it off and to really dive into it. And we did exit out of a handful of relationships based on those conversations. And what I think it was kind of reflective of, you could actually tie this back to our bottom-up process as well, even though I'm kind of characterizing it as top-down, in the sense that I think those managers were not being creative enough or innovative enough in thinking about potential risks. And so even on a bottom-up basis, even if you didn't think this was a paradigm shift, you could have also made the same judgment we did. So that was very helpful, and that was an example of, we were getting all this data from certain investment managers about how the internet was impacting them, and we went around to make sure everybody was having those same thoughts.
And do you see either climate as a similar thing, where you would go around and talk to all of your managers and say, how's climate affecting you, or inflation, or geopolitics? Is there another, is this something that happens, once in a blue moon, or do you think we're seeing a number of these potential paradigm shifts right now?
For whatever reason in our portfolio, the fact that there were people who were not thinking about the internet seemed to happen in greater proportion versus today when we talk to our investment managers. Climate is on everybody's mind, inflation is on everybody's mind, and I don't know why there's that difference, but we haven't seen the need to go through our portfolio in quite the same way, because I think our managers are already there. So I don't have a great thesis as to like what the difference was, other than the fact that well, it may be just off the top of my head, maybe the fact that the internet was so associated with tech companies, and there were people in these various industries who said, well, I'm not a tech investor, I invest in banks, or I invest in, industrial companies, whatever it was. And therefore they had this very mental separation. Whereas something like climate and inflation, those factors are just, they cut across everything. And therefore maybe it's a little more obvious to people that these are going to be trends and things for people to deal with everywhere. And it's a little harder to, take the mentality that, oh, that doesn't affect me. So maybe that's the difference, but that's a theory. I have no data to back that up.
Yeah, maybe crypto is the analogy to the old internet, because a lot of people are not sure if that does affect them, and maybe it will and maybe it won't, but I think it's also sort of techie, right? So
Absolutely.
So one of the things obviously MIT has that not every investor has is a whole bunch of alums who are techie, sort of by definition. How do you think about using your alums? Do you call on them as experts? Do you like for them to introduce you to people? Do you invest with them? Is that a conflict? How do you manage that? Because you do have a fascinating group of alums, some of which are probably very close to MIT as an institution, and some are probably, they graduated when they were 22 and that's the last time they looked at it. So how do you think about using the alums?
The MIT community is wonderful, and we've gained enormous benefit from them. And I would say that that would include the faculty, the students, the administration, so lots of kind of on-campus things that happen, off-campus conversations. But speaking to alums directly, the way we've interacted with most alums in the most productive way has been on diligence efforts, where we're able to call somebody either at a company, at like a startup company, to ask them about the company's venture capitalists, or call somebody in some industry, or call somebody in some geography, and just kind of get general background. And the advantage, it's kind of a twofold advantage. One, either more likely to return our calls because of the connection to the university, number one, and number two, they're more likely to kind of give us the plain honest truth because they feel loyalty to the institute and they want to help. And so it's a very genuine type of conversation as opposed to, a random cold call, even if we've never met. So that's been incredibly productive. And I've taken trips to, taken a trip to India and met with alums and talked about the investment landscape and talked about, potential investments for us and potential investment managers for us. And so, just extraordinarily kind of useful, conversations. The only downside in it, and it happens, and this gets to your conflict question, the only downside is we've had a few, and it's been very few, but we've had a few people, MIT alums, who have believed they should get special treatment or special dispensation when thinking about where MIT should invest its capital. And when we make it clear that there is no special treatment in the works, and again, it's been very few people, but some of them have gotten upset. And we actually had, it was a board member of MIT, actually, this was years ago, so it's nobody in present day, who ended up resigning from the board because we would not invest with their firm, and I assume has not donated to MIT since then, and so on and so forth. But the support that I got from MIT's investment committee and from the administration during that was incredible, because they were just like, no, that's not, like, we make decisions based on, we make rational investment decisions. We don't make investment decisions because we want to support some alum in doing X, Y, or Z. And so everybody around the table was very clear on that, and we were able to, kind of do that. And honestly, it's been, it's a tiny fraction of our interactions have ended up that way. But that, unfortunately, that is a reality of the world, and it's probably not a surprising reality, but it's, it's always a little disappointing when we run into it.
Yeah, I'm sure it doesn't happen too often, but there is that rub there. What do you think? How are you thinking about? You mentioned climate before; it's affecting all the businesses, but there is this sort of ESG movement out there, some of which is very future oriented. The climate is changing. Obviously, you've got to think about what the climate looks like in the future to think about how businesses succeed. Other is more putting into place boundaries around your investment because of the needs or desires of your constituents, whoever it might be. You obviously invest most of your money, or all of your money, essentially through third parties, external managers. So you're also working through others. How do you think about building, a portfolio that you're comfortable with from an ESG point of view, and also partnering well with people who may have a different set of characteristics?
So as our investments, have transitioned from, if you look decades ago, MIT invested at the security level, like we own securities directly. And obviously, as you mentioned, over those decades, we've migrated to this model of investing through investment managers, where the investment managers make the security selection decisions, have the day-to-day control, and often, we're often primarily invested in commingled funds alongside other people, where it's not just our opinion and the manager's opinion that matters. There's other opinions around the table. All of that has meant that our ethical investment policies have also had to move primarily from the security level to the manager level. Now, there's some exceptions to that, which I can talk about. But so at the manager level, we're really working hard to identify managers who will make thoughtful decisions in tough situations. And it's kind of a constant conversation that we're having with people. And it's, what do you do? What do you do when Russia invades the Ukraine? Now we happen to have almost no exposure to Russia, so there was only a couple of conversations we had, on that front. We had a real estate manager who, had some tenants that, were, this happened to be a marijuana. I forget if it was a distributor or a grower, but there was a marijuana tenant, in the building. And so what do you do when the state laws are permissive but the federal laws are not? And this was a number of years ago, maybe before it was as clear as to how this was going to play out. We've worked with timber managers who are looking at timber investments, and if some piece of a timber acquisition is old growth forest, how did the manager deal with that? And so through these different kind of interactions, and they really are like the situations are very complex and very specific, and so it's hard to make these very general rules about things. It's how does the manager conduct themselves in these situations, and are they making thoughtful decisions that we would agree with, that we learn a lot, and then we try to react based on that. In one sense, we may try to convince a manager to take a different course, and that may or may not work because they have a lot of other people around the table telling them one thing, or they may have economic interests that tell them to go down a path. And our option in that case is to then extract ourselves, from that relationship. Hopefully we're doing, enough diligence and enough work up front, and enough, as part of our kind of good fiduciary, good partnership, we are, asking a lot of questions about how people make decisions and how they think about tough situations, that we avoid, getting into partnerships with managers who end up in these kind of gray areas. But it happens, and in those situations, we just have to kind of extract ourselves and kind of move on to the next one. The situations I mentioned that's at the manager level. At the security level, we've joined Climate Action 100 plus, and so that's in that type of situation. That's a group that's obviously getting investors together to work with companies to help companies improve their climate efforts. That's a situation where we can join a group and operate in a constructive way at the security level. And in some ways, it's less important that it's MIT owns a big look-through stake in these companies, and it's just as important that it's kind of MIT having the conversation. So it's almost not even about how much exposure it is, through our managers. But that's how in a selective way we can get involved continue to be engaged on a security level basis.
I like how you put being a good fiduciary with making good decisions on those things, because oftentimes you see in the popular press that those two are juxtaposed against each other. Well, it's my fiduciary duty to maximize return, even if it means selling my grandmother, so I think there's I think the lens of a good fiduciary thinks carefully about these things is something that we should take forward.
I totally agree with that. And that, I was actually listening to your podcast with Nitin Noria, and, he was talking about how, business is part of society, and business only, can operate within the context of society. And so the idea that you can somehow just, maximize profits without thinking about what, the needs of society is not a useful lens in my view. And that, all credit to him for, phrasing it that way. What do you think MIT will be invested in 50 years from now? You mentioned 5-10 years, but is there any way to think about, you're on the leading edge of technology, of crypto, of changing the world? Are you going to be, you've got an investment office on Mars? Like, what's good? Just tell us the crazy things that you all might be thinking. There are always crazy ideas at MIT. What would be 50 years? No, we're not going to be around to check you, so it's okay. Yeah. So so a couple of years ago, we actually looked at what MIT owned 50 years before. So 1970. So this must have been 2020 when we did this. We said in 1970, what did MIT's portfolio look like? And it was vastly different from what we own today. And so we have exposure to, if you look through all of our venture capital partnerships and all the kind of little pieces of private companies we own, several thousand, different securities, on a look-through basis. We're invested all over the world. We're invested in lots of different, asset classes. In 1970, we had less than 250 securities in the portfolio. It was all U.S. stocks, U.S. bonds, and a little bit of local real estate. We had 25% of the portfolio was in 4 stocks. It was like Kodak, IBM, Ford, and GM. And so putting myself in the shoes of somebody managing that portfolio, I don't think I would have had a great been able to have predicted that 50 years on, the portfolio would look so different. All of which is to say, I think I want to be really humble about our ability to think decades out and even have any idea what predictions will be made. The one thing I would say is that it's hard for me to imagine that 50 years from now, there's not a significantly higher use of AI-assisted decision making, maybe in life, but certainly in the investment business, and that that kind of adoption, that over that time horizon, it's hard to imagine that you don't get an awful lot of adoption of. My hope is that humans are still very much in the center of it in making the decisions, but that having things that are AI assisted kind of across the board will be in the investment business, and I think it's in the investment business today in a very small way, but nowhere near the type of impact that we could see over time. And my hope would be that MIT, being a place obviously where there's a lot of AI research going on, that MIT would be able to be at the forefront of some of those trends. It's not something that we're particularly aggressive about in the portfolio today, and it may be that you need a different set of people. We need to hire a slightly different set of people to come in and think about those decisions, because it's certainly not my skill set. But that if you had to pick one trend, that to me seems like a pretty obvious thing. Over decades that would be different about our portfolios, and that we need to start thinking about how we use our data to get there, so we're not left behind when the trends do change.
I love the long-term perspective, the thinking about what could change, and also obviously the funding of the Institute, decades out, because some of that money invested in 1970, as you said, is probably still funding some research today, which is what's so important. So thank you for spending your time with me today. Thank you for all your work for MIT, and thank you for being such a leader in long-term thinking in the investment community.
Well, thank you very much for having me. This was great fun.
Thanks for listening to today's episode of Going Long with FCLT Global. To learn more, visit our website at fcltglobal.org.